So we calculate our discount rate by using the weighted average cost of capital. So this is used to determine the discount that we're going to use to bring our after-tax cash flows back to present dollar equivalents. So the weights determined in WACC are based on the target capital structure for the firm, or they can be based on the current market values of the various sources of funds. So we have all of this information about a company and their current debt and equity information. So they have a bank loan, they have mortgage bonds, they have non-callable preferred stock, and they have common stock. Their current CAPM is 20%, and they have a 40% income tax rate. So we start off by taking our rate times 1 minus 0.4 or 40% in order to get our after-tax rate. We then take our book value and look at our book value versus our market value based on the information that we're given in our example. Then our weight is the amount of market value divided by our total. We then take our after-tax rate times our weight to get our weighted average cost of capital. We add those together, and here our weighted average cost of capital is 13.3875%. So we're looking at the cost of using preferred stock is equal to the current dividend yield on the stock, or the current dividend per share of preferred stock, divided by the current market price per share. So that's where we see the 10% coming from. So what we use the net present value then, looking at what our WACC is. So we want to discount all future net of tax cash inflows to the present value using the WACC as the discount rate. We're going to discount all future net of tax cash outflows to present value. If the net present value is over 0, we can accept the project. That means that the project adds value to the company. And if the net present value is less than 0, we would reject the project because it does not add value to the company. So we're going to look at estimating the net present value when we're going back to that Mendoza Company example. And we're assuming a weighted average cost of capital of 10%. So we would discount all of our cash inflows and outflows using that discount factor of 10% for all 4 of the periods. This gives us a net present value of $29,240. We can also calculate net present value in Excel using the net present value factor. So using the net present value built-in function in Excel, we would have our weighted average cost of capital each year and then the cash flows for that year. We then use the B4, which is the year outflows, plus the net present values of B1, and that's our rate, 10%, and the sum of years 1 through 4 outflows. This gives us the same net present value of $29,240. We can also look at the internal rate of return model. So the internal rate of return is an estimate of what the true rate of return on a proposed investment project is. The internal rate of return is the rate of return that results in a net present value of 0. If the internal rate of return is greater than our weighted average cost of capital, then we should accept the project. If it's less than, then we should reject the project. In order to estimate the internal rate of return of a project, we want to use the built-in function in Excel. There is a trial and error approach that we can use with the present value sheets, but if future cash flows are uniform, we can use an annuity table to identify in the row corresponding to the life of the project and an amount equal to the ratio of the initial investment outlay to the equal annual net of tax cash inflows. However, if future cash inflows are uneven, it is best to use Excel to calculate the IRR. So in this example, we have an internal rate of return of 11.8%, which is higher than our 10% required WACC. So in the IRR formula, the 0.09 is a guess, which is needed to start the algorithm used by Excel to estimate a project's IRR. We also have a modified internal rate of return. So the MIRR is the IRR adjusted to account for an assumed rate of return associated with interim project cash inflows. It assumes that all positive cash inflows are reinvested at our weighted average cost of capital for the remaining life of the project. It's a more conservative estimate of a project's rate of return. We can also use the MIRR function in Excel to calculate this formula. NPV, IRR, and the MIRR provide investment recommendations, which is to accept or reject a given project based on whether or not it meets an arbitrary return that the company has set. Sensitivity analysis then looks at the sensitivity of the recommendation to estimated values for the variables in the decision model. So any sensitivity analysis that we can do for capital budgeting are what-if analysis, scenario analysis, and Monte Carlo simulation analysis. The what-if analysis generally involves changing one variable, so maybe the discount rate or the weighted average cost of capital, but we would change one variable at a time in order to see what is the best case scenario, what's the worst case scenario, what would be the break even after tax cash flow amount using the goal seek option we could do. So here's an example of what if analysis. So we have three different discount rates, and using changes in after-tax cash flows and discount rates for a project life of 3 years. So if it's $7 or $8 or $9, and looking at different discount rates. For scenario analysis, we would want to look at how the proposed investment project would fare under different combinations of variables called different scenarios. This is a form of sensitivity analysis that's appropriate when the variables in a decision model are interrelated. So in looking at different scenarios, we could have a disaster scenario. So what happens if there's a disaster in the middle of our project? What would be a disappointing scenario or an optimistic scenario? And we would use the built-in function in Excel for performing scenario analysis. Monte Carlo simulation is an MCS analysis. So this is a computer-generated analysis based on repeated sampling from a distribution associated with one or more input variables. It has extremely limited capabilities in Excel, and you're actually better off having higher powered computer data processing programs than Excel is able to manage. With real options, we're looking at a theory on how to make decisions regarding investments when the future is uncertain. So we look at the different financial options, like the net present value and the IRR, and compare them to the actual real economy. So any of our real options might include that option to delay, option to expand, option to abandon an investment project, or the option to curtail or scale back an investment project. Real options should be used to complement our capital budgeting analysis and not replace it.